All right, guys, welcome back to another edition of the EFG Podcast. We've got the A team today. I'm joined by my friend and colleague, Karo Cornips. Karo.
Oh, thank you for having me.
Yeah, it's good to see you on. For the audio listeners, I'm looking very fresh. Karo a bit less so.
At least I got some uniqueness in what I wear.
Fair enough. That's fair enough. I will just give you guys a bit of a warning. If you have a little bit more delicate sensibilities, this may be a little bit more of a hot take, if you will, than our previous editions.
It's called It's a Shit Stock. So, I mean, you know, the title kind of gives away the type of language that we'll be using. But I think we'll try to keep it M-rated rather than R.
Absolutely. We'll keep it all above board. We'll try and make it entertaining. And guys, if you do enjoy the content, please, go down and give us a subscribe, give us a like, maybe leave a comment. It would really help us out a lot.
Yeah, even if it's controversial, we're going to be picking on a bunch of stuff today, and we're very aware that our shots fired could certainly receive some volleys back, and if that's what you want to do, by all means, we're happy to duke it out. The focus is on stocks that get a lot of momentum behind them, but as I like to sing, it's a shit stock after all. And you can kind of see the writing on the wall a lot of the time, and I think this podcast, as much as it's meant to be fun, is also about trying to identify when stocks are in that kind of runaway period. And it's all well and good to jump in on them, and investing in them is, I think, certainly a strategy that you could employ, especially if you didn't have kind of a backbone in another area of investing. But at least kind of getting an idea as to the longevity of those positions, so that perhaps after the stocks run, you can maybe just get out before experiencing the pain of watching it all disappear in front of your eyes.
Absolutely. And I just want to say, if you're getting your stock tips from a Facebook post or from a hot copper thread, and that stock is a stock that's got no revenues or no profit and has jumped 100% in the past few months,
it's a great stock.
Most likely you're the sucker letting someone else get out. And look, we're not going to try and rag on too hard, because a lot of these pipe dream stocks, they have been experiencing a bit of hurt over the past few months, and you don't want to punch down at all. So.
Well, yeah, it's in good fun, but it is also about learning, right? And so sometimes through baptism through fire, or martyred in blood is probably a good way to kind of to learn ultimately, right? There's an emotional response there as well.
Absolutely. And just on the topic of learning, I guess, one of the things that I think is most important for beginning investors or inexperienced investors to learn is the business looking to make money for the investor, or is the business looking to make money from the investor? And it's a subtle but important distinction. If you're going into a small cap stock and they're basically trying to sell you the whole world and doing a bunch of cap raises, and perhaps some of the initial ownership or founders or initial investors are getting out on the IPO or getting out in soon after, it's not always a good sign.
I would say it's a big red flag.
Yeah, and there's plenty of businesses on our market who the listing is the exit strategy. It's the way for the early investors to take money off the table, and a lot of the time they're looking to make money from investors as opposed to for investors.
That's a really important distinction to make, actually, and I feel though that would be hard to find out. Like, how do you?
It can be hard to find out. The things that I would be looking at are, when something is IPOing, is there any sellout of the existing equity holders? So that's the first thing.
How do you find that out, though?
So that'll be listed in the prospectus of the business.
That giant thing that nobody reads that they say they do. It's
Absolutely.
like you're asking someone to read the terms and conditions.
Yeah. Well, I mean, you ultimately you should. And if you're receiving paid advertising about it, don't listen to that advertising. Go and look at it yourself. Go and look at it yourself. There's a lot of people in the investment world who aren't looking out for your best interests. They're looking out for their own interests, and they're not always aligned with your interests. And so by doing things yourself, by getting educated, and essentially sometimes you can pay people as well to give you advice. That's where you're going to come out ahead than if you're receiving something for free and it's got a whole bunch of marketing language around it. you've got to be a bit more skeptical.
Yeah, that's actually a fair point. The more kind of jazz you see around something, the more wary you should be. I mean, I don't know if we're just cynical bastards.
Oh, we certainly are, dude. We certainly are. But it's hard not to be after 8 years in the Australian stock market.
Yeah, the more you see something advertised, the more you see hype, the more that you see... but I mean, that being said, that also means that you and I also miss out on these types of runs sometimes because we're so cynical.
Absolutely. But one thing I would say, though, is if the people who get the majority of the run are not the people who hear about it through online marketing, through rocket ship posts on Facebook, through hot copper threads, through ASX bet posts. Then they're getting fractions of the run, and the majority of them will get a lot of the downturn. And that brings me to my second point: is there are also good stocks out there that are just extremely overbought, overdone. You know, you got people buying into a stock who, in best case scenario, will start making a few dollars profit in 5 years' time, might not make, a profit for 10 years, and trading at multi-billion dollar valuations. And even if all the stars align, between now and then, there'll still be periods where they're a lot cheaper than that in that 10-year stretch. And yet, there are people out there who believe they just can't possibly ever come down. They're just going to keep running up. This stock that's gone from $50 million to $2 billion is sure to go from $2 billion to $10 billion, despite core business activities not starting for 5 years' time.
Yeah, you see that with there's like some of that with miners as well. I get hints of that. It's like visions of that when you hear about drillings and the expectation of potentially finding, perhaps if one day, if it's the right thing at the possible time, and perhaps in some point in the future, maybe we'll find a little piece of something in the ground.
And I just want to say that it's a lot easier to, 10 times your valuation when you're a $50 million cap than it is when you're, $1 billion, $2 billion
scales,
cap.
right? Yeah,
Absolutely. So that feeds into, I guess, my third point here is there's a lot of investors who get emotionally invested in positions they take on. So they don't want to hear the negativity about those positions, and they're not able to look at them rationally. And
present company included, I might add. It's not easy to kind of break that. The idea of sunk cost biasness, where you put too much money into it, and so you kind of have to believe that. That's we see that in other parts of life as well, right? Mm-hmm. You have to stay in that relationship with something because you've already just put so much behind it that accepting that it's no good or that it's wrong or that you've wasted a lot of time and money, whatever it is a painful admission, to the point where it's just easier to lose money. Right, it's sometimes your own
it's
ego
more comfortable,
can be very expensive.
It's more comfortable.
Of course. But at the end of the day, I think being aware of it is probably the first step.
Mm-hmm. Absolutely.
We should become psychologists. I think we're obviously armchair psychologists. If you will. We need armchairs in here with some whiskey.
Yeah, we're certainly counsellors as well.
Our clients aren't in good hands as counsellors. So shall we look at some shit stocks?
Yeah, let's have a look. If you are one of these companies, please don't sue us. This is our opinion only. It's subjective. There's no stock that's objectively shit. So anything we say is
if they were a manure company, then they would be.
Then they're a literal shit stock.
Well, maybe we should find one of those.
Yeah. Let's start with one, I guess, well known to us in the office. Do you want to start with Zipco? Zipco.
What did you like about Zip?
Well, what did I like about Zip?
Was it Zip?
Look, an attractive name. They had the numeral 1 in the code, which was at the time a little more rare than it is now. I guess that was fairly attractive about it. But the problem is we went through peak, buy now, pay later stage, and they still couldn't, turn a profit. And now we're moving into a higher interest rate environment, which should really do a lot of damage to the buy now, pay later world. We're seeing high levels of bad debts, and providing those sort of services are just going to be extremely costly moving forwards, and it's at a time where there's a whole bunch of competitors coming online. So they just weren't able to perform when it was the golden age, and now that we're moving out of the golden age, the share price is going into the dark age.
Yeah, well, I think the whole idea of high interest rates makes these things like. At some point, though, you're going to get bottom feeders come in, and bottom feeders will drive the price up, I think, against all odds, right? These types of stocks run on like memes become dreams, life imitates art, right? They're hopium stocks.
Oh, absolutely,
right?
and it's a bit of a low blow, calling a stock like this out, because all the investors already know.
Well, I think the damage is done. I'm hoping we run through a few stocks where we can perhaps give a bit more warning, because the damage is done here. I mean, Zip's trading at a pretty key level of support, mind you. But it could certainly go back to the days where it was trading below $1. I think that's certainly on the table.
Yeah, absolutely.
Maybe there's some intrinsic value in the stock that I don't know about, but I don't know. Maybe there's some IP there, or
well, they've got the merger with Sezzle coming up, and we'll see what the combined business can sort of put together.
That's like Sim buying like scrap metal, as in Zip's the scrap metal, like the offcuts, of the company.
No, I wouldn't necessarily say that's the case.
I'm being an asshole. What else we got?
Let's have a look at Douugh, D-O-U. This is one I got asked about back when it was like 18 cents, and I basically did a bit of research. Is it 18 cents? Yeah. Did a bit of research it'd come off a fair bit from its highs.
I love how the name is like Douugh, because it's literally the sound that Homer Simpson makes when he hits his head. Douugh.
I believe there was another Douugh as well that had one less O in it, and I think that's the reason why this is spelt as it is. But yeah, I did some research, and what are you getting for your 20 cents a share, which at the time was well over 100 million in market cap, I believe. And it's you were getting nothing essentially at the time. There's actually a lot more to the business now, because they've developed their apps and things like that. But really, you were getting one guy's idea for a fintech business. They called themselves a bank initially, and then the Australian regulators told them not to say that because they didn't have a banking license. And yeah, fintech business listed with very little.
You can't call yourself a bank, but that doesn't seem fair. I mean, if I lend you money, am I not a bank? If you give me money, am I not a bank?
Well, unfortunately, the regulators here in Australia,
oh god,
think
what a nanny state.
Yeah, I mean, it is
just over-regulation, hard-working, dig it. What would they say? What would the diggers say?
Yeah.
But this is, look at the classic rug pull, right? They set them up and then knock them down. But in fairness, this had a second hurrah. You can see some hopium there where people are kind of just getting back on the hype train, and then slowly it dies out, and then people capitulate and slowly sell down their holdings as they realize that it's not going to see that glory again. Now, one day it could, right?
Yeah.
I mean, everything's on the table. We are being bombastic in our approach, but in our day-to-day jobs, we're much more, I would say, conservative.
These guys now have an app. They're bringing users online in the US.
An app?
They've got an app.
Oh, that's like 20 cents of share price right there, right?
Well, and this is another point I have to say is cents per share. You could have a 3 cent stock at a few $100 million market cap. It's not indicative of the value of the business, how the share price. I get a whole lot of clients looking at small miners going, oh, it's only 20 cents a share. It must be a very small company. But, they may have issued a whole bunch of shares, and they're trading at a high market.
It's like how many times you're cutting the pie,
exactly,
right, or the pizza.
Exactly.
Yeah.
The early warning sign on this was one of the directors selling his mother's escrowed shares at 9 cents a share. He ended up having to
his mum's escrowed shares.
Yeah, and this was on the run up. This was before it got to 40 cents. So if you were still holding them,
that guy's an idiot.
Yeah. I think he had to buy them back. There was a whole bunch of stuff going on around that, but that was the early warning sign.
Sold his mum's escrowed share.
Yeah. Yeah, this is all alleged and our opinions only. So,
look.
all in good nature. All in good nature.
Oh, I have some bad nature with it.
Well, I don't know.
Yeah, some.
Trying not to get sued.
That ship sailed, man. What else we got?
All right, let's... not one in particular. What I want to touch on is a theme at the moment, so maybe a bit of early warning here: uranium stocks. We can look at Paladin, for example. I don't know if that's a great example because Paladin's a long-lasting, historically producing Australian uranium producer, but uranium stocks in general. No Australian uranium mining company can really produce profitably at current uranium prices. Even if they skyrocket substantially further than they have already, Australian uranium is still unprofitable. So all this, all these companies doubling and tripling in prices based on, the strong uranium price, it really doesn't hold out from a longer term perspective because we've just never proven we've been able to do it profitably. And I've heard the uranium story. I heard it first in high school, heard it in university more than 10 years ago, heard it when I first started in the business, and I'm hearing it again. And I'm sure, in 3 or 4 years' time, I'll hear it again. But between now and then, you're not going to be making any money, in my opinion. Uranium has already moved, and these stocks have already moved. So
what's a code that I can pump in?
Well, PDN would be the classic example. That's already started to come off. I'm not saying this won't have another peak, because these themes can last for as long as...
You don't have to caveat it. Like, the thing is, we're not necessarily telling you what to buy and sell, right?
No.
But what we're trying to do is just give you an idea that, some stocks that appear genuinely good because of share price movement might be shit stocks after all, as the song goes. You know?
Absolutely. If you want to jump on the uranium theme, physical uranium, invest in physical uranium, like the Sprott Uranium Trust, something like that. But Australian uranium miners, unprofitable.
I'll tell you what. So if we take PDN as an example here, my boy Sammy's saying that uranium isn't a success story at this point because it's something
uranium mining.
Yeah, uranium itself from an energy perspective is probably a success story, but that's a different conversation altogether. In terms of the actual stocks though, like if we look at PDN, what can help in terms of knowing when to exit can be applying short-term technical analysis and having a set of trading rules. So, if there was any kind of seriousness in this webcast that isn't kind of underpinned by, bad jokes and cynicism, is that, ultimately what can really just help you get out of trouble is having a set of trading rules, using short-term technical analysis, and trying, I guess, in that way to alleviate your emotional response to things. So, using PDN as an example, you can see that I've drawn in a fairly simple uptrend line. I've drawn in a fairly simple counter trend line. And when those two things occur, it's called a pennant pattern, which is a very classic run-of-the-mill triangle pattern. And you can see that the momentum still remains to the upside. So whilst that goes on, there's no good reason, even if the stock was built on hype, that you couldn't hold it until, perhaps that breaks. And if it does, and you sell out of your position and you make some money, great. And if you still see it rise, well, that's, I guess, part of the cost of having a set of trading rules. That's part of the cost of trading,
Absolutely. I think, and you bring about a good point, is disciplined, successful traders won't get on every successful trade. It's very easy to sit and look at something that's gone up and be like, oh, what could have been, or I could have doubled my money. But there'll always be more trades. There'll always be more investments. That's just the nature of markets. In fact, there'll be more in future than there have been previously. There'll always be more. However, if you lose all your money, you won't be able to participate in those opportunities.
Yeah, and I can tell you right now, taking and this happens. I find this with my own trading. I'm always better off leaving profit on the table and taking a smaller profit, because often the times I don't do that is when I get smacked. And it's much harder to see a profit go into a loss than to see a stock that you've closed out of that shouldn't really have any bearing on your mind anyway, because it's not in your portfolio anymore, keep going up. And like Caladius is a good example of that. I bought into that and I took a small profit and it just kept going up. And you can sit there and rage, right? And it's fun to get, to do that because it's just my personality. But it has no bearing on me. Like, I don't care because it's not in my portfolio. I don't have to think about it if I don't want to. And I can pleasure myself by getting angry at the stock because I could have stayed in longer for my own emotional sadism, right? But if you don't take that small profit and it does go into a loss, you are actually forced to deal with that stock continuously, maybe not each day, but like over time, because it's something you have to deal with,
Yeah. And it creates more emotional pressure being in that situation. I guess, the one thing I would say is that, and then I tell this to a lot of our clients, is that there's one guy who gets the bottom price and there's one guy who gets the top price, and they're different people. You're never going to get the absolute bottom and get out of the absolute top. So, be disciplined in your approach. When it breaks your trends or support levels, or resistance levels, those are your entry and exit points.
Yeah, I think a lot of what we're talking about are fundamentals, right? Because we're talking about shit stocks.
Yep.
So there's no such thing as I don't think as a shit stock technically. I mean, there's stocks that are lamenting, but I think we are talking about fundamentals. If that is your approach, and that's totally reasonable, just maybe consider implementing some short-term technical analysis, a bit of tea leaf reading, just to kind of round out your decision making.
Oh, absolutely. Fundamentals are very, very important, and one of the reasons that we're doing this is to implore Australian investors is to act more rationally, more fundamentally, but they'll never tell you when to get out, or if they do, it's often a bit too late.
It's the hardest decision that you're going to make, though, right? Getting out, is tough. It's the hardest decision you'll make. Getting into a stock's easy. It's not hard at all because, it's like hype, the excitement of it. It's super easy to get into a stock. Closing a stock's a different beast. It's probably the hardest decision you'll make as a trader, right? Do we want to go through another stock?
We've probably run pretty long on time.
Just quickly though, with uranium, doesn't Australia have like the second?
We've got tons of uranium.
The second highest deposit in the world or something?
We've got, look, I couldn't tell you the overall.
And when we say uranium, are we talking about refined, or are we talking about like yellow cake, or are we talking about
unrefined?
Unrefined.
Just mined uranium. We've got some of the biggest amounts of it on Earth.
Yeah,
we just can't mine it profitably. Even after the huge price increases that it's seen, it would need to go significantly higher again.
Jesus.
So yeah, I mean that's
okay.
Something we'll have to keep in mind.
All
right. Look, we have run a little bit late. We try and keep these brief so that you guys stay interested and don't let your mind wander off to something else.
Before we leave, though, is there anything that we should warn people about? I haven't got anything on my radar that I think is in that kind of rug pull territory just yet.
No, I think, like I said before, if you're into moon stocks, you're probably already feeling the pain.
Yeah.
With the government bond yield curves turning to the upside. Yeah. Those very, very high growth, forward growth stocks have started to come down in value. And it makes sense, right? Because their valuations are predicated on very strong future growth. Higher interest rates will lead to lower future growth, or that's the conventional thinking.
Less free money, right?
Bringing those valuations down. So if you're into the moon stocks, you're already feeling the pain, I implore you to think a bit more valuation-based moving forwards. And look, the other thing I'll mention is, if you like our content, we're a business. We educate people to invest and to trade. We do these podcasts and videos for free, but shameless plug.
Shameless plug.
We provide financial advice. We run paid courses. So if you do have an interest, we'll put some information in the description.
Yeah, and our advice is a lot more sound than us just calling something a shit stock. We do have a rules-based approach.
Absolutely.
We do like to lean on technicals for shorter term and fundamentals for medium to longer term. But we like to incorporate both into our decision making. And I think we've both been doing it for like 8 to 10 years. So we've got enough experience that we should be able to translate it for anyone who's kind of new to this or want to round out what they're doing.
Absolutely. All right. Well, it's been an absolute pleasure, Karo.
Oh, well, no, the pleasure's all mine, Sam.
Well, Well, thanks very much, and I hope you guys enjoyed the video.
Thanks, guys.